Everyone is chasing the obvious AI winners in 2026, but some of the best opportunities may be hiding in quality stocks that got sold off hard. In this video, I'm breaking down 7 names that market punished and whether the fear created real value. For each stock, I'll show you 3 things: why it's down, what the fundamentals actually say, and my bear and bull fair value range. So let's start with the big picture. 7 quality companies, all sold off, but not all for the same reason. And the stocks are Meta, Amazon, Microsoft, Netflix, Uber, Adobe, and Nike. For each one, we're going to look at the drawdown, the fundamentals, and then the fair value range, so you can decide whether this is a real value or just a value trap. And just a reminder, it's not a financial advice, it's just my opinion, so make your own research before investing. So let's start from Meta. Meta is a perfect example of stock getting cheaper even while the business stays elite. The stock was around 601, down 24% from its August 2025 high of 796. And the reason is simple, it's capex fear. The market became obsessed with how much Meta plans to spend on AI infrastructure, with the 2026 capex guidance rising to roughly 125 billion to 145 billion. Investors are asking whether this is a visionary spending or whether Meta is overbuilding before the returns shows up. That fear is exactly why the stock looks cheaper than the quality of the business would normally justify. Now here's where this story gets interesting. Financials still look extremely strong. Meta reported Q1 2026 revenue of 56.3 billion with operating margin above 41. That tells you that the core ad business is still incredibly powerful even while the company ramps spending. So yes, the market is worried about the future returns on AI spend, but right now the business is still showing massive scale, strong monetization, and a very resilient operating engine. If the market is pricing Meta like a spender instead of compounding machine, that could be the opportunity. The buy now case is straightforward. Meta is still growing fast, trading around 18 and 2 times forward earnings, and already showing high monetization potential. That makes the risk reward look very attractive if you believe the spending will pay off. So my bear case is around 650, where the AI spend takes longer to pay off and valuation stays muted. And my bull case is around 827, which is close to the Wall Street average target set in June 2026. Next one is Amazon, and it is another stock where Wall Street saw spending and immediately assumed trouble. Amazon was 242 on the moment of recording, down 13% of its May 2026. It was 278. The reason behind the sell-off is free cash flow worry. The market focused on the fact that Amazon is spending heavily on AI infrastructure, chips, logistics, and warehouse automation. So instead of seeing strategic investment, investors saw lower near-term free cash flow and got nervous. But if you look past the spending, the core business still looks very healthy. And we have this story with Amazon that they start to spend more and then they reduce the spending all the time. AWS growth had re-accelerated to about 28%, and Amazon's chip business was described as roughly a 20 billion annualized business growing triple digits. That's not a profile of the company throwing money into the black hole, in my opinion. So what that says to me is Amazon is not just spending, it is spending into real demand, and that is a very important difference. Sometimes the best buying opportunities come when investment makes the short-term number looks ugly. And this may be one of those uncomfortable phases where investment depresses near-term cash flow while building a much stronger business for 2027 and 2028. If the market is too focused on the 2026 free cash flow, it may be missing the long-term upside in Amazon Cloud, chips, and logistics. So my bear case is $250, assuming capex stays heavy and margin gains are slow, and my bull case is 297, which matches the most of the analytics predictions. Next company is Microsoft, and it didn't really sold like a broken company, it got sold like a former favorite. Microsoft was around 390 on the moment of the recording of this video. It is down 30% from its October 2025 high of 555. The market started questioning Microsoft AI positioning. It depends on OpenAI and whether agent-based AI could weaken parts of the legacy software model. That pushed the stock down even though the underlying business remained very strong. And when you look at the numbers, Microsoft still looks like a machine. External reporting is about 82.9 billion in revenue, 18% of growth, around 20% of operating income growth, and roughly 15.8 billion in free cash flow. Those are not weak numbers, these are really strong. So the market became more skeptical about the business itself, kept compounding through Azure, Office, and enterprise demand. So this is what gets interesting. One of the best businesses in the market, but no longer priced at peak optimism. That combination is usually where long-term returns start to look attractive. Microsoft still has one of the strongest positions in the enterprise software and cloud, but the valuation is much more reasonable than it was before. So my bear case is about 430, where growth stays solid but the multiple does not expand much. And my bull case is 520, considering the AI investment will be returning faster. Another one is Netflix, maybe one of the clearest examples here of the market overreacting to a temporary slowdown. Netflix price is about 76, down about 15% year to date and roughly 40% from prior highs. And the main reason, in my opinion, is content slump. Investors were disappointed by the lack of major breakout hit in 2026, and that led to the concern about subscribers' momentum and whether Netflix could keep engagement high without constant blockbuster releases. But the business logic underneath Netflix is still very powerful. The argument is that Netflix keeps strengthening its own content library, and that matters because owned content compounds in value over time instead of expiring like a licensed content. So even if one quarter feels weaker creatively, the long-term economics can still improve. If the market is treating a content draw like a permanent decline, that may be the mistake in my opinion. All it takes is few strong releases for sentiment to flip quickly in the stock like Netflix. If the platform keeps proving the durability of its library and margins, today's price could look too pessimistic in my opinion. My bear case is $95, assuming content will stay uneven, and my bull case is 127, matching the fair value of the analytics. And the next one is Uber. Uber is where the market may have let headlines to do much of the thinking. Uber is about $70, down from about 100, and this was framed as a narrative-driven sell-off in my opinion. So the core reason was a robotaxi panic. The market got excited about autonomous driving and started acting like Uber would eventually become obsolete. And whenever that kind of disruption story gets hot, investors often move faster than the facts. But in my opinion, scale still matters, and Uber has a massive scale. One of the key points is that Uber handled about 3 and 6 billion trips in quarter. That tells you this is not just an app, it's a massive global demand aggregation platform. On top of that, Uber has been partnering with autonomous vehicle platforms, which means it may become the distribution layer for the robotaxis rather than the victim of them. On the top of that, Uber has been partnering with autonomous vehicle platforms, which means it may become the distribution layer for the robotaxis rather than the victim of them. The question is not just who owns the autonomous car, it's who owns the customer. Replacing Uber marketplace density is much harder than the headlines suggest. Distribution rider habits, merchants relationship, and app liquidity all matter, not just the vehicle technology. So my bear case is $90 where autonomy helps but competition caps upside, and my bull case is $126 where I am assuming Uber remains the dominant demand platform even as autonomy expands. And the next one is the most hated quality software stock on this whole list, I think. I am myself in the loss with this company, and it is Adobe. Adobe is around 205 at the moment of the recording of this video, and the stock was described as a crash from prior highs near 380. The fear here is very clear: AI disruption. Investors worry that AI tools will commoditize creative software, make alternative cheaper, and weaken Adobe grip on the market. On top of that, leadership uncertainty added even more pressure. But when stock gets hated this much, the question becomes whether the business is falling as well, or whether sentiment is just collapsed. Adobe still has very strong economics in my opinion. It remained highly profitable, generated strong operating cash flow, and still owned critical creative and enterprise marketing workflows. The gap between the market fear and the business quality is exactly why Adobe stands out. If AI strengthens Adobe's suit instead of replacing it, the current valuation may look way too low. And to be honest, that is really the bet. If AI becomes a feature that deepens Adobe moat rather than breaks it, then the stock does not need perfection to work. It just needs the market to realize the moat is still there. So my bear case is 260, assuming slower growth and only a partial sentiment recovery, and my bull case is about 380. And this includes that AI will be just improving the Adobe products. Yeah. And the last one is Nike. It is different from the others on this list. This is less about tech fear and more about patience running out. And I'm in the loss with this stock as well, and I really hate it sometimes, But the last quarter, as I mentioned, if it will be bad, I will be selling it off. But the last quarter was really good, to be honest. The Nike price is 43 right now, and I think it's still undervalued and wide mode based on Morningstar March's 2026 view. The Nike price is 43 now, and I think it's still undervalued, and it really has a wide mode. Investors have been frustrated by soft demand, margin pressure, and how long it is taking for the recovery to gain traction. So the market is treating Nike more like a stock story than a comeback story, in my opinion. But under the surface, there are signs this is not a broken brand. It is a business working through a reset. Nike fiscal third quarter 2026 revenue was 11.3 billion, and management said actions to improve the health and quality of the business were gaining traction, even if the recovery was uneven. That matters because it shows the turnaround is slow. It's not dead. And when the brand is still one of the strongest in the world, slow progress can still be enough to make the stock interesting, in my opinion. So, wide mode consumer brands usually become interesting when investors stop believing in them. The buy now case is simple. Nike is still one of the strongest consumer brands in the world, and when a company like that gets deeply discounted, even modest execution improvements can drive a meaningful re-rating. My bear case is $75, where the turnaround stays sluggish, and my bull case is around 102. So it's basically matching Morningstar's fair value estimate from March 2026. So those are the 7 names like Meta, Amazon, Microsoft, Netflix, Uber, Adobe, and Nike. And what I like about this group is that every one of them has a different reason for being down, which means this is not one generic trade. It's 7 separate opportunities to find mispricing. If I had to summarize the list, Meta, Microsoft, and Amazon are the quality platform bets. Uber and Adobe are more sentiment-driven re-rating plays. Netflix is the content cycle contrarian, and Nike is the consumer turnaround set. The big takeaway is this: in a market where everyone is crowding into the obvious winners, some of the best opportunities may come from high-quality businesses that are temporarily misunderstood. So if you enjoyed this breakdown, subscribe for more investing videos where we go beyond hype and focus on businesses' quality, valuation, and long-term opportunities. And see you next time, guys.